Let's talk about mistake number one, buying the wrong assets in the wrong accounts. Now, in the introduction, we discussed the difference between a capital asset and an ordinary income asset. And now you've learned that anytime you buy an investment inside of a qualified plan or an IRA, and remember, it can cover an IRA, a SEP, a simple, a KEO, a 401k, a 401a, or 457 or 403b. These are all plans before tax. Anytime that you buy a capital asset, and what is a capital asset? It could be a REIT, it could be a piece of real estate, which we're going to talk about in some of the further mistakes, how you buy real estate inside of a plan. But most of the time, it's when you're buying a stock or a mutual fund that's equity-based. Now, many people make the mistake of buying capital assets inside their IRAs. Now, we're going to use a simple example, 50-50 portfolio. Let's say that you have $1 million and you have $500,000 in a non-IRA, and you have $500,000 in an IRA. Now, typically, what the public does is they'll buy capital assets inside the IRA, meaning that they'll buy stock. And in the crowds that I've spoken to in the past, I ask them, why do you do this? And their answer is, well, the stock has the higher potential for growth, so that's where I want to buy it because it's tax deferred. Then they'll buy bonds in their liquid account, in their non-IRA account. Now, let me tell you what a big mistake this is. First, a bond is going to spit out interest every single year, and you're going to pay tax on that interest, whether you use it or not. And here's the downside. You're going to pay ordinary income tax on the interest from the bonds. Furthermore, if you have a capital asset, the higher the IRA grows, the higher the required minimum distribution gets. Now, as you get further into these video series and find out more mistakes, you're going to find out why you do not want a very high required minimum distribution. It's going to cause all kinds of tax traps, tax triggers, tax explosions. Now, when that argument comes in and somebody says, I'm buying stock because it's tax deferred, I hope you understand that if you buy a stock or an ETF, you still get tax deferral outside of an IRA or outside of a retirement plan until you sell it. And that's the beauty of it. If you're a day trader, yes, maybe an IRA is the better thing. But we've already proven in many statistics that those people don't make very much money. So if you're going to buy and hold or buy and reasonably hold, it makes more sense to do it in a non-IRA. Why? Because you're getting capital gains tax treatment, which is up to half of the tax that you would pay if you had that same kind of growth inside of the IRA or retirement plan. So let's take a look at it, 50-50. I buy bonds in the non-IRA and I buy stock in the IRA. IRA stock grows, it creates a higher required minimum distribution, plus I'm paying ordinary income taxes on my bond. Then when I take my required minimum distribution, I'm taking it at ordinary income tax bracket. Not a good tax plan. You're probably giving up a big percentage of your returns to the IRS. Now, what happens if you flip those things? You put the bonds inside the IRA. All that taxable interest every year is sheltered. On the flip side, your highest growth assets are now in your non-IRA. You do not pay taxes on them until you sell them. And when you sell them, it's only at capital gains tax brackets. Here's another issue. When you pass away, the assets that are in your non-IRA will pass to your heirs 100% tax-free. It's called a step-up in basis. So they can inherit the stock with no tax. Unfortunately, if you put stock inside of your IRA, it is not eligible for a step-up in basis. So there are so many multiple points on why it makes sense to have the correct asset allocation between IRAs and non-IRAs, and that's mistake number one, where people misallocate the wrong investments to the wrong accounts.